Ladies and gentlemen, welcome to the Contrarian Investor Podcast. I'm Tom Wallace, and today I'm absolutely privileged to be joined by one of the most knowledgeable natural resource investment executives in the entire sector, Jason Stevens. Jason has spent the last 11 years working with mining and petroleum engineers, influential industry executives, investment newsletter writers, and economic geologists. So I'm delighted to have Jason on the show to share some of his extensive technical knowledge of the resource sector with all of us. We have a whole lot of listener-submitted questions to cover, so I'll kick right into it. Jason, how is a junior resource or junior mining company defined?
Well, let me start off by saying that I don't think there's one good definition of a junior resource company or junior miner, however you want to say it. How I refer to a junior is any company in the mineral business that produces less than 200,000 ounces of gold equivalents per year. So that broad description kind of includes three types of businesses, which is exploration, so guys that are hoping to make an economic discovery, project developers, so companies that have made a discovery and now are going piece by piece through the process of proving it's, one, economic, two, putting in the infrastructure to start mining. And then the last one is just a small producer, a producer that produces, like I said, smaller than 200,000 ounces per year in annual production.
It's not uncommon to see massive daily swings in the juniors. What are some of the reasons for the volatility?
Well, the great thing about these junior resource stocks is that they're layer upon layer upon layer of reasons for the volatility. And the reason I say that's a great thing is because you need to make volatility your friend in this business. If you're not, as Rick Rule says, if you're not a contrarian, you're a victim. And that's why I like the title of your podcast so much, is simply because it's so true. If you're not buying at the bottom, selling when there's euphoria in the market, you're probably being used by that same volatility that could be working in your favor. So back to your question, not only are these companies high risk, high reward, but they're also very capital intensive. So you go from doing geophysics to very expensive exploration work to infrastructure, putting in infrastructure, and then putting in sustaining costs to keep the mine producing. You combine that, or if you combine that with the kind of risky nature of the actual technicals of the underlying securities, most juniors have extremely low trading volumes, and you also have underlying cyclical nature of the actual commodity. So I'm very interested when you start to see the volatility work in the favor of the investor, which means stock prices go down. When we start to see the euphoria, and we haven't seen that really since 2007, but in the short term, or in the last 2 months, we've seen the bounce off the bottom that has taken, in some cases, some of these stocks up 50%. I don't know necessarily that's, it's definitely not sustainable, but to call it, working in a frothy market, I think it's short-term frothy, but at the same time, there's a lot going on in this world, all working in favor of precious metals. So that's kind of the idea of the volatility in the underlying stocks. But the metals have been kicked around pretty good for the last few years, so I'm pretty happy to see the stocks recovering with a slight move in the metals.
As a subscriber of Casey Research, I've found their system of stock evaluation to be nothing short of excellent. Can you give my listeners a brief rundown of the process that you use to evaluate a junior mining or junior resource company?
Sure. Well, first of all, we're very close friends with the Casey Group, and I would concur in terms of the 8 Ps, as they call it, as a very sound way of doing research on each part of the business that's important in natural resource evaluation. We have done something a little different. Rick, many years ago, put together 10 interrogating questions that we use to delve inside and have the company managements reveal to us, all the dirty little secrets at the same time giving us the information we need to know to make an informed decision. So that is actually, we put that into a natural resource guide, which your listeners who want to email me at jstevens@sprottglobal.com. So that's JSTEVENS @sprottglobal.com. I'll certainly provide that to them. But really what it does, it dives down into the important parts of the businesses. So what we're looking for is the liquidation value. We're looking for things like geopolitical risks. When are they going to make us money? Or how long until their money makes us money? So those are some of the things that we're looking for. And like I said, it's kind of spelled out in those 10 interrogating questions. And we do that in combination with our geologists who have been to 50 different projects in 2013, going there, kicking the rocks, actually using the history of their knowledge from major mining companies to evaluate potential exploration discoveries.
Jason, what are some of the main risks facing a junior mining company?
Well, there's many risks to junior mining investment and junior mining companies in general. I usually break them down into 4 categories. So you have geopolitical risks, you have financial risks, then you have the technical risks, and I guess I can add a fourth. The fourth is usually management. So in terms of geopolitical risks, you may have heard a lot of people, especially as of the last 5 years, talk about mines as if they were piggy banks from most of these governments. Well, they're fixed assets, and they're very good targets for politicians. So raising taxes, trying to actually get the permits, that's one of their ways of negotiating on fixed assets. So that's one of the few risks. Financial. Do they have enough money to make you money? So are they just financing to get to the next catalyst to move the stock up so they can dilute more? Or do they have enough money to put them through or answer the question that will make you money? Technical. Is it favorable geology? Is it going to be expensive or hard rock to mine? Do they have the potential infrastructure to, one, mine it cost effectively? So all of these things are something that need to be taken into consideration when looking at these junior mining companies. And the fourth I added was management. Quite frankly, is there a reason that they can't, or is there a reason why they're not motivated to make you money as a shareholder? So by can't, do they have the background to make you money? You saw in 2007, you saw a lot of mediocre management teams start up uranium exploration companies. So they went to the hot commodity, which was uranium. So went from about 5 uranium companies to over a couple hundred uranium companies. And then not too long after that, the hot commodities were rare earth minerals. So you had all these mediocre management teams working rare earth minerals, or they took the same shell of companies and repackaged it as a rare earth mineral. So that's what I mean by, do they have the wherewithal and the ability to make you money in what they're doing? And then they have motivation to make you money. Are they just collecting a salary, or are they shareholders themselves? And that's a great motivator. In my case, there's no motivation like self-motivation, and there's no interest like self-interest.
In 2013, we experienced a pretty big pullback in the sector, but it was a necessary one. Is the sentiment different this year, and what's the smart money doing?
I would say yes. The sentiment is different, and it's different for a few different reasons. In terms of the sentiment, you have ETFs changing course. They've been net buyers of precious metals. You've seen M&A, or merger and acquisition activity, pick up. You've seen investment banks moving towards bought deals on junior mining acquisitions or private placements. All these things kind of move towards the idea that they're expecting that we've hit a bottom. And then you ask what the smart money is doing. Here at Sprott, we've signed 2 mandates from 2 large Asian companies. One is a joint venture between Korean Electric Power and the Korean Pension Services. They have them, and the largest Chinese gold mining company, which is Zijin Mining, has both created investment funds co-managed by Sprott Inc. to invest in natural resources. So they're moving in the direction of interest of all natural resources, not just mining, but certainly they have a heavy interest in hard rock minerals.
When it comes to production costs, could you explain the difference between C1 and C3 costs?
Sure. So C1 is basically cash costs, and that includes the costs at site of any project. So when we're talking about at-site costs, we're mainly talking about mining, milling, transportation, admin at that project. And C3 is kind of looking at total costs, and that will add in amortization and depreciation, which kind of is a proxy for the capital expenditures into that project. And then it adds in indirect costs and royalties on the project, if any, or if there's any royalties from the government. So those are the 2 I would consider it cash costs and then full production costs. What we've seen as of lately, a few years back, Gold Fields kind of coined a new production cost metric called all-in sustaining costs. Still a minority of the larger companies are using this, but what it tries to do is to also incorporate sustaining costs, development drilling, and other costs that are associated with actually maintaining the mine, doing reclamation at the end of the mine's life, or throughout the process. But that's an important part because simply it's not just direct and indirect costs, but also G&A to the company. So you have high expenses out of the corporate office. That all needs to be added in at some point, and I don't want it to be from my shareholder value. If it's talking about cost, that should be added in. There are some fudge factors in that number which have not been worked out, including how they determine the costing of development drilling, what's considered development and exploration drilling. And so it's not a perfect number, but it gets you, I think, closer to the number that should be recognized. And on those metrics, most of the major companies are not making back their cost of capital.
At what gold price level are most of the miners profitable?
If you take into account that gold was at $1,650 was the average price for 2012, 90% of the large mining companies, so the senior producers, actually had a negative free cash flow at $1,650. So now we're looking at $1,350 gold prices. Costs, to a certain extent, have not dropped that much. And if the costs that have dropped are capital expenses, not necessarily operating expenses, I suspect if we continue to see gold prices moving higher, one of the big drivers of it will be the fact that some of these big mining companies realize that they can't even make money at $1,500 gold.
From an investment standpoint, how does Australia fare when lined up against other natural resource exporters, and what are some of the things that are preventing further investment in the Australian mining industry?
Well, first to be said, Australia has many advantages, and I'd say a few are pretty obvious, which is the history of resource production in general and their proximity to the Asian markets. So those are pretty well known. There are challenges. I guess one of the most recently publicized challenges has been rail access and infrastructure challenges, and also the infrastructure costs. So they're all of the challenges that Australian has are all kind of interlinked. So rail access, there's been disputes between mining companies about sharing rail access. I mean, energy management is a huge issue for Australian mining companies. It can be a matter of 40 to 60% of their total costs is energy. And then I guess one of the other big items is resource depletion. The fact that they've been mining so long means that they're starting to mine more remote and lower grade assets. So all of these things means, I think, costs are going up. And unless there are new projects discovered, not only in Australia but other places, seems like that break even is starting to move up quite drastically after 2016.
What has you excited investment-wise going forward?
Well, certainly the mining in general is exciting simply because we're coming off such a low base when it comes to the junior mining sector. I also am really focused on finding other sort of juniors and smaller producers of agriculture commodities. And I know you had Rick Rule on not too long ago, and he was talking about water. Most of the times, those agricultural investments and water investments overlap. Those are things that I'm doing due diligence on now, and our company is also doing due diligence on. So I would say that the drought here in the Southwest is not only a potential opportunity, but I think there's going to be a revaluation, much like you saw in Australia, which has been kind of the best example of the privatization of certain water rights.
For all my listeners who are interested in learning about Austrian economics and free markets, where would you suggest they begin?
Well, I think to start, you really need to understand where the philosophical basis for free markets comes from, and I think it's individual rights. And so I would definitely start with the person you have to talk about when you talk about individual rights, which is Ayn Rand, and her magnum opus, which is Atlas Shrugged. So really to get a philosophical understanding of what free markets mean to the individual, I would start there. But if we want to talk about more economic books, I would look at F.A. Hayek's The Road to Serfdom and also Henry Hazlitt's Economics in One Lesson. Both give an understanding of what damage can be done by governments if you allow them to undertake and control the economy.
Where can my audience find your work, Jason?
Well, the best place is at Sprott's Thoughts, which is the publication of 170 people here at the Sprott Group on both sides of the border writing their piece on all natural resources. If you send me an email, again, at jstevens@sprottglobal.com, I will be happy to not only sign you up for that publication, again, Sprott's Thoughts, but also my monthly account of as much news as I can fit in one newsletter monthly about natural resources.
You're also going to be a contributing writer for the new social media publishing platform Liberty.me. Could you share a sneak peek with my audience of some of the content you will be touching on?
One of the big things I've been focused on here in the last little while is writing a lot about what sets successful speculators apart from everyone else. It certainly is as much work as we do here at Sprott to inform the speculator, the guys that were taking higher risk to get higher reward. As Rick so often says, the number one risk is what people have between the ears and how they use their brain, how they use their mind. And I think for the most part, giving those characteristics of speculators and what sets them apart from the herd. And I think the contrarian investor and those that think differently, at least giving an outline or a profile of that person is something that I'd like to do more work on. And also, obviously, getting more information out about natural resources and natural resource investing.
Ladies and gentlemen, you've been listening to investment executive Jason Stevens from Sprott Global. Jason, you've been extremely generous with your time today, and it's been an absolute honour having you on the show. Thank you for joining me on the Contrarian Investor podcast.
Thank you very much, Tom. Always a pleasure.
If you enjoyed today's episode, please subscribe to my channel and share the link to this video so I can continue to bring you informative interviews with the best people in the business.